Okay, let's just jump right in. We've all been there, right? You carefully plan a trade, you place your stop loss exactly where it's supposed to be, and then you just watch the market completely zero in on your stop. It hits it, and then instantly reverses right in the direction you predicted in the first place. It is literally the worst feeling. You're sitting there agonizing over it, kind of wondering if there's some secret algorithm out there specifically designed to hunt down your account.
Well, to answer that, we really need to stop playing the victim here. Spoiler alert. Major institutions are absolutely not hunting your individual 100-share stop loss, I promise you. What's actually happening is that price is moving purely because of order interaction. And the massive gravitational pull behind all of that interaction, it's a fundamental concept known as liquidity.
So let's dive into Section 1, the stop loss trap.
Now, you've probably heard the term before, but it actually means different things to different people. In traditional finance, your big banks, your market makers, liquidity is really all about the bid-ask spread. Basically, how easily can they move an asset without causing a massive price shock? But for traders using smart money concepts, it means something entirely different. For them, liquidity is all about specific areas on a price chart that are literally hiding massive concentrated pools of resting orders. It's like a giant magnet for price. Which brings us to Section 2, unmasking market liquidity. So how do we actually spot these hidden pools? Well, you want to look for really obvious structural points on the chart. Imagine a stock hits $100, right? It drops, and then it bounces back up to exactly 100 before getting rejected again. What you have there are glaringly obvious equal highs. Short sellers are going to park their stop losses just above that line, and at the exact same time, breakout traders have their buy stops sitting there waiting to trigger. This dynamic turns things like equal highs, equal lows, previous major swing points, and even important session highs and lows into incredibly visible targets. And this essentially creates a two-sided battlefield for us. On one side, we have buy-side liquidity, which sits right above those obvious highs we just talked about, like that $100 mark. That is a massive cluster of buy-to-cover stops and breakout orders, just waiting to ignite. On the flip side, sell-side liquidity rests just below the obvious lows. This area is completely packed with the sell stops of long traders. You really have to understand, these are not just random levels on a chart. They are literal clusters of market fuel, just waiting for a spark. Actually, quick timeout before we go any further, because this is a really crucial warning. Liquidity and volume are absolutely not the same thing. I see this mistake all the time. A massive volume bar? That just tells you how much total activity happened. It doesn't guarantee market depth, and it definitely doesn't guarantee tight spreads. So please, don't just look at a giant green candle and oversimplify things by saying, oh, hey, that's liquidity. It's not. All right, let's move on to Section 3, Anatomy of a Sweep. And this brings us to the infamous liquidity sweep. Basically, this is the market's way of going fishing. Let's say the market establishes an obvious high. Price pushes just a tiny bit past it, which triggers all those resting buy-side orders. Suddenly, retail traders are screaming, break out, and they take the bait, hook, line, and sinker. But then, almost instantly, price snaps right back below that line. What just happened? The market literally just grabbed a liquidity it needed to fuel a massive move in the exact opposite direction. But you've got to beware of the classic beginner's trap here. Please do not automatically short every single sweep you see. Seriously. If price breaks a resistance level and you blindly sell into it just assuming it's a stop hunt, you might literally be stepping in front of a freight train. If actual true buying volume steps in, well, that's not a sweep anymore. That's a genuine breakout, and it will absolutely obliterate your account. Remember, liquidity provides context for your trades. It is definitely not some magic guaranteed reversal signal. Let's formalize this. Section 4, a smarter trading framework. We need to replace all this guessing with a solid professional framework. It's a simple 5-step process. Step 1, identify the obvious level. Step 2, mark that specific zone, but, try to keep your charts fairly clean. Step 3 is the hardest part for most people. Wait, do not enter early. You have to let the market come to you. Step 4, really observe the reaction. Does price blast straight through, or does it violently reject? And finally, step 5, wait for a structural confirmation so you can properly manage your risk. Let's lock this in with a quick example. Say a stock hits an obvious high at $200. It pulls back, and then it returns right to that level.
Okay, you mark it. Then price sweeps up to $202, but suddenly, bam, aggressive sellers step in and slam it right back below 200. What you have right there is clear evidence of a failed breakout. From there, you just wait for a short-term structure break, a visible crack in the nearby trend, you define your exact risk, and then you execute. If you take absolutely nothing else away from this whole explainer, please remember this one thing. Don't trade liquidity. Trade the reaction to liquidity. I'll say it again because it's that important. Trade the reaction. Liquidity is just a location on your map, nothing more. If price blasts through your zone and just keeps on going, you don't fight it. You just accept that the market didn't give you a setup today and you move on. That level of discipline, that is exactly how you survive in this game. So, as we wrap up, you really have to ask yourself a tough question. Are you actively hunting for liquidity, or are your own orders actually the liquidity being hunted? Because let's be honest, understanding sweeps is really just the very beginning. To truly read the tape like a pro, you need the full context. So where should we go next? Should we decode the rigid rules of market structure, or maybe unravel the magnetic pole of fair value gaps? Think about it, let us know, and we'll see you in the next explainer.